Brennan's going to look at Nutrien, which has kind of done not a similar type trajectory over the past year. Certainly a larger company, but when people ask us to value Nutrien all the time, it's a dominant player in the fertilizer market, potash and nitrogen in Canada. But because of the fluctuation in the underlying commodities, it is very difficult to value this company. So Brandon's going to take you through that.
Well, that's my analysis. So,
all right, we're done. Let's move on.
No, I do have some things to go over. But generally, I mean, Ryan's hitting the nail on the head. But we got a question on YouTube asking, can we get an update on Nutrien as it continues to go lower? So Nutrien, NTR on the TSX. It's also NTR on the New York Stock Exchange. Currently trading on the TSX at about $64.62 with a market cap of just under $33 billion and a forward dividend yield of 4.6%. So Nutrien is the world's largest provider of crop inputs and services, playing a critical role in helping growers increase food production in a sustainable manner. They produce and distribute approximately 27 million tons of potash, nitrogen, and phosphate products worldwide, and they have 6 potash mines in Saskatchewan. My cousin actually works at one of them. So I covered Nutrien back at the beginning of 2022 when the stock traded at about $110 per share and with a forward enterprise value to adjusted EBITDA multiple of 4 times off of management's fiscal year 2022 guidance provided in May of 2022. But throughout 2022, the company lowered its initial guidance in August and then again in November because potash prices were sliding and wasn't as tight of a market that management had expected. And these decreases in guidance followed into 2023, revising guidance lower in Q1 and Q2. So looking forward to the full year, fiscal year 2024, management is guiding toward potash sales volume of about 13 to 13.8 million tons, which compares to about 13.2 million tons in 2023. Nitrogen sales volume guidance of about 10.6 to 11.2 million tons, which compares to about 10.4 million tons in 2023. And phosphate sales volume guidance of about 2.6 to 2.8 million tons, which compares to 2.6 million tons in 2023. So they are anticipating growth in volumes here, essentially. However, the company revised its guidance practice in 2024 to focus on providing forward-looking estimates that they believe are of value to shareholders and are less impacted by changes in fertilizer commodity prices. And as such, they only provide retail adjusted EBITDA guidance of 1.65 to 1.85 billion. But they indicate that they are now providing adjusted EBITDA price sensitivity charts in their investor presentations for each commodity. So this is where they're, pushing investors to look now. So looking at these charts, if the price of its commodities stays around the midpoint of their sensitivity analysis, we're looking at approximately 5.6 billion in adjusted EBITDA for 2024, whereas they achieved about 6.1 billion in fiscal 2023. So this would place the forward enterprise value to adjusted EBITDA multiple at this time around 6.6 times, which is essentially more expensive than both times that I covered the stock on the podcast. Now, moving to the most recent financial results, just very quickly here. We are recording the podcast on August 6th, but the company reports its Q2 2024 results tomorrow, August 7th, after market close. So looking at the Q1 2024 results reported back in May, keep in mind their results are in US dollars. Revenues were $5.4 billion, a decrease of 12% over Q1 of 2023 due to lower net realized selling prices across all segments. Adjusted EPS was 46 cents per share, down about 59% year over year, and adjusted EBITDA was down 26% year over year to 1.1 billion. Now, looking at the balance sheet, as at March 31st of 2024, Nutrien had net debt of about 13.1 billion. And using that forward 2024 adjusted EBITDA that I previously cited. They have a forward net debt to EBITDA multiple of about 2.3 times. So to conclude on Nutrien, this is really just a quick segment, but fundamentally, I do think that it is a good business. They're still cash flow producing, but like Ryan said at the beginning here, he stole my thunder. It's a very hard business to predict. As I went over, many potash companies had lofty guidance in 2022 and 2023 with expectations of potash prices to remain high due to what they thought was a tight market. However, management continued to revise guidance lower over several consecutive quarters. And as Ryan said, when I covered Verde Agritech, another potash company based in Brazil, he said, what is the point of providing guidance if you're just going to keep moving it around with the volatile price of commodities? We just can't rely on it confidently, as even management can be wrong on the market dynamics, which they were. So I certainly think it's interesting that Nutrien has now gone to a more lenient approach by simply placing in price sensitivity charts in their investor presentations and providing production guidance rather than a specific adjusted EBITDA range. And really, this is the bottom line. If the price of fertilizer goes higher, the stock will likely do well. And the opposite is true if fertilizer prices go down. So looking at my points that I have up on the screen here, Nutrien has been returning capital to shareholders through its dividend and share buybacks. It does pay a nice yield of over 4.5%, and the trailing payout ratio of adjusted earnings is about 56%, which is reasonable. The company does have long-term targets of growing its potash sales to about 18 million tons by 2027. They're currently, looking at about doing 13.5 million tons for 2024, and the nitrogen division is anticipated to do about 13.5 million tons by 2027, where it's currently around 11 million tons right now. Now, in April, management initiated a process to divest its retail assets in Argentina, Chile, and Uruguay. These regions account for approximately 3% of global retail sales and around 2% of adjusted EBITDA. And management said that these decisions reflect its focus on core geographies to enhance the quality of its earnings and cash flow, which obviously is good to hear. And the guidance, which I cited previously, did not exclude these regions as management has no clarity on when a sale will take place. Now, the company is just lapping its tough comparable financial results from when potash prices were elevated, which I say is a positive generally. The balance sheet remains healthy. Now, if potash prices remain in the same range going into 2025, as long as production volumes do increase with their guidance, we should again see some growth back in its financials, which have been essentially non-existent for the past couple of years due to declining commodity prices or fertilizer prices. But, if you believe potash will do well over the next few years, you could take a position. But, just for like Keystone, we're looking for constant cash flow growing businesses, which Nutrien just isn't.
Yeah, it's really difficult to value a business like this. And you look back at the share price, and the market tells you it's been difficult to value. It's the start of January 2028 listing. It's around $69. You know, today it's below that price 6 years later, in that range. It's been as high as the 140 $50 range in the kind of COVID or post. I think it was the war bump that it got, the invasion of the Ukraine, but it's been as low as $40 as well. You can maybe trade this company. It is, these type of commodity based businesses are very difficult to value the way we value companies, on a cash flow basis, growing that cash flow and cash flow per share basis. Highly fluctuative. The revenues have generally grown in Nutrient over the past, since 2014, but had a huge spike in 2020. It was 7.5 billion 2014, up to 37 on a trailing basis. So that looks like good revenue growth, but operating profitability has fluctuated significantly over that period. So it's very difficult to value them based on the way we would like to see a business grow and be valued. you take a different approach and you'd be more of a trader. You'd probably buy it when it had the worst cash flow
Yeah.
that you've seen in the last 5, 8 years or 5, 10 years, and then you'd sell it when everything looked great. Like
And that's
that's just and it's hard. Those are terms that are very they're nebulous, really, right? Like you don't like, it looks great and relative to what, and it's, there's not hard and fast rules, and it's very difficult for us to say like we can value a business based on its historical multiple to cash flow to see whether we think, generally speaking, it's expensive or cheap or reasonably priced at that point. This company, when it probably looks the cheapest, it's probably the time to get out, and that's a lot of commodity based businesses. But again, that is just a general,
yeah.
because you could have 2 more years of it looking great, and you don't know where the commodity price is going. It just overlays another level of risk that is very difficult to forecast. If you knew how to forecast nitrogen and phosphate or fertilizer prices long term, great, you'd probably be very, very successful in investing in this company. Good luck doing that, right?
But
That's
yeah,
what
like
I
the
would say.
amount of times that, we come across the financials of a company, like in the steel industry, like I've got, Algoma Steel. I remember, steel prices were going absolutely ballistic, and all of a sudden the stocks, like, we're getting tons of questions from client, or not clients, but, just on the podcast, I guess probably clients
Yeah.
as well, asking like, wow, it's trading at 4 times EV to EBITDA. This is a screaming buy. But like Ryan said, it's when you're dealing with a commodity price, it's almost pays off to be that contrarian investor, getting in when all of a sudden cash flow is almost the lowest, and that EV to EBITDA maybe 20 times rather than the 4 times. And again, there's no, like he was saying, there's no strict rule that is going to work out. But again, this is just the issue and the difficulty with dealing with commodity based businesses that is so tough. When like Brett was saying, looking at Cipher, we saw that low valuation. We had confidence in the business's growth, beautiful cash rich balance sheet. We had a great case. But when all of a sudden we're looking at a commodity based business trading at 4 times EV to EBITDA, well, what happens when all of a sudden that commodity turns, and realistically looking forward, it should be trading at 20 times.
Yeah.
And with really all commodity companies, whether it's oil, fertilizer, coal, iron, anything that's like that, is so driven by macro developments, geopolitical. So, like you saw before in the
So hard to
invasion of
predict.
Ukraine, yeah, which you're just simply not. If you are predicting the invasion of Ukraine on that month, like why are you doing that? And you're not a
Yeah.
whatever CIA analyst or something. That's what I would
Yeah.
expect you to be doing. And I'm sure that there's some hedge funds that hire those types of people. But the thing is, you're not going to be able to do those predictions over and over again. You're not going to have that reliability, and it could really come from anywhere. So if it wasn't Ukraine, it could have been some other war. It could have been you could have had another pandemic. You are not going to have one person who's able to predict all these macro effects, which always impact commodities again and again and again. You don't have that reliability like you do with a manufacturing company, with even a pharmaceutical company with Cipher.
Yeah.
You don't have that, and that's the issue again and again you have, and that's why management can't even predict it. The people who are looking at this stuff day in, day out, year after year, day after day, they can't predict it. So unless you somehow have some omniscient insight, you're not going to be able to predict the earnings and therefore the valuation.
Yeah.
Yeah, when you're investing in an individual company, you're building that investment case, and then you're trying to de-risk it. Well, you can build an investment case for investing in a commodity-based business, but it's hard to de-risk because you have to predict where the commodity price is going to be, and it's just overlays that risk that makes it very volatile. There are rare commodity based businesses that have increasing cash flow per share on an annual basis over time. Maybe if you're on the royalty side or something and you're executing tremendously well, you can do that. But it's very difficult, and then it often doesn't fit our criteria. And you often look back at where these businesses go. And that's what we'll do. If we found that commodity based businesses over 20, 30, 40, 50 year periods we're all doing this up over time. I don't know if you can see that, right? That we would probably find a way to value them, but there is not the amount of charts that I see in that sector that actually go up in a jagged line over time are very low relative to, businesses where we can track cash flows and they grow over time, like the Boyds of the world, the Hammond Powers, from way back, the Brookfield Infrastructures, like these companies that have that jagged upward trend over a 5, 10, 25-year period that we're looking for. It's very difficult to do that in the commodity space.
If you ever look at like a sell side analyst or like a bank report, if you get that from TD or something like that, for most retail, that's probably your exposure to that. They'll say in their bear and their bull cases and their base cases, oil prices or copper or whatever it may be aligns with our analyst expectations for this, because they have to build their valuation off those prices. And most of the time they're just as wrong as we are when it comes to commodity expectations. That's the reality.
So if the commodity price moves 10, 20% off those assumptions, they're all blown out. It looks very concise, looks very well thought out, the analysis in there, but you can even have a 5-10% move and it can blow those estimates out of the water, and it makes that report basically useless. So, and if your analysis is rendered useless by a 5-10% move in a commodity, you might as well not issue the report. And this goes back to the guidance that we saw there. I mean, you have management who intimately know the market, they know the company, and they're constantly revising that guidance. And then they've gone to a method that doesn't really even factor in cash flow. It just tells you how volatile that sector is. How can you then invest with certainty in those type of companies? I mean, that should give you an idea when you see management continually having guidance, having to revise it, and then going to a different methodology to try to capture some kind of forward guidance. It shows you that they don't have a handle on it. How the hell can you have a handle on it as an investor? So just know that, these are they're highly speculative, any commodity based business. You can find ways of playing the commodity sectors. We've done it. There's a gold related company that we've invested in, but it's been profitable for 12 consecutive years. I mean, there's ways to gain exposure to commodities that are different from the way most investors do it. We do it for our clients all the time. So, I mean, it doesn't mean you're precluded from investing in commodity or related businesses. You can do that, or you can find a special situation where, I mean, we're looking at a company right now. I'm not going to say the name of the company, but like it has, 50% of its, just like Cypher did, if it's market cap in that range in cash, and we could see a scenario where it could have more. And, you get some margin of safety. If you want to invest in a commodity-based business, please look for a margin of safety, whether it be the cash, some other way that it's doing business that's different from the typical commodity-based business that allows them to be significantly profitable every year. So these, you can do it. You just got to think a little bit outside the box and find unique companies. And again, that's the way we have gained exposure to commodities, and it's served our clients well over time, and we'll continue to do it that way.
Yeah. And that's
all right.
One last thing. Cause I mean, Brett brought this up earlier. And I do think that it's a good point. And just like for my own, I've learned this over the past 5 years, just from learning from Ryan and being in the stock market myself, but just how much a cash rich balance sheet or, a large cash balance can act as, protection to help for, a potential bottom in a stock. To make sure that, rather than if all of a sudden there is a downturn, rather than a stock running from, $2 down to 10 cents because they've got debt, it acts as a floor, essentially. Yeah. So again, I just think that is something, especially when we're looking at a commodity based business, that's something that you're going to want to help, mitigate the risk. Anyways.
Yeah.